Welcome back to the deep dive. We are jumping right in today to what is, well, arguably the biggest regulatory shift coming to India's secured lending market.
It really is. We're talking about something that could fundamentally redefine household wealth.
Absolutely. This is the formal launch of the Silver Revolution. And it's not just a small tweak. This is a direct challenge to centuries of, traditional savings culture and, more importantly, to that massive unregulated credit system.
It's exactly right. And our mission for this deep dive is to unpack the source material around the new RBI directions. The full name is a mouthful. The Reserve Bank of India Lending Against Gold and Silver Collateral Directions 2025.
Right. Let's just call them the 2025 directions for sanity's sake.
Yes. The thing is, historically, silver has largely been confined to informal markets, or it's just been, well, dead capital.
Okay, let's define that for a second. When you say dead capital, you mean it's this huge store of value that could be driving economic activity, but it's locked up. It can't be easily used in the formal banking system without being sold off.
Precisely.
Mm.
It's wealth that's just sitting there with no liquidity or formal recognition, and the sheer scale of it is astonishing. I mean, the sources show 78% of rural households in India own silver.
78%.
Yeah, compare that to 62% for gold. That is a staggering amount of untapped wealth, especially for low and middle-income families.
I was floored by that number. So despite this huge penetration, only gold had a formal lending structure. So what changed? What's the why now?
The change is the recognition. Effective April 1st, 2026, these new directions officially recognize silver ornaments and coins as legitimate collateral. The RBI finally realized that all this silver value was locked out because of, storage challenges and no standardized valuation.
So they're creating the mechanism.
They're creating the whole framework. It moves silver from a passive heirloom into a dynamic financial tool. It's a complete game changer for financial inclusion.
Okay, let's get into that transformation. Gold loans are already huge, right? Something like 1.42 lakh crore in outstanding credit as of March 2025. Why was it so hard for formal lenders to get into the silver space before this?
It really came down to a mix of practical and cost barriers. The main problem is density. Silver is, well, it's bulkier and cheaper per gram than gold.
So high volume but lower value density.
Exactly. So if you're a bank trying to secure a loan of, say, 5 lakh rupees, for gold you need a small box. For silver, you need a much, much larger storage footprint.
Which drives up cost.
Drastically.
Yeah.
Storage, security, logistics, insurance. Our sources suggest it's nearly double the cost compared to gold for the same loan value. Formal lenders just didn't have a standardized, cost-effective way to manage it all.
So with these new standardized rules, the economics start to work. What's the immediate impact we're expecting to see, especially in rural areas?
The socioeconomic impact should be profound. These silver loans are designed to penetrate deeper into regions like Gujarat or Rajasthan, where silver is the preferred saving asset. It gives families quick, affordable credit for, farm expenses, health emergency, seasonal business capital, things they need now without having to sell their assets.
And crucially, without having to go to the local moneylender. It sounds like a primary goal here is to pull people out of that often exploitative, unregulated world.
That is the critical piece. The whole idea is to shift borrowers away from those unregulated players who charge insane rates and use coercive tactics and bring them under the RBI umbrella with regulated banks, NBFCs, and co-ops.
What are the numbers telling us? How big is this new market we're unlocking?
The potential is enormous. Even a conservative estimate suggests that if just 10% of this household silver enters the formal system,
Just 10%.
just 10% could unlock somewhere between 25,000 and 30,000 crore in new rural credit. In the first year alone, that expands access to small secured loans by about 20%. It's huge.
That's a massive shift. Okay, let's get into the nuts and bolts of the 2025 directions. What can a borrower actually pledge now?
The framework is very specific, and it's really designed to curb speculation. So, loans are allowed strictly against silver or gold ornaments, jewelry, and coins. That's the list of eligible collateral.
And what's explicitly off the table? I'm guessing they want to stop people from taking out loans just to buy more metal as an investment?
You've got it. It's explicitly prohibited to lend against primary metal. So, no bullion, no bars, no ingots, and no financial instruments backed by them, like ETFs. This is all about unlocking household capital, not fueling a commodity market.
But there's a small exception, isn't there, for industrial use?
Correct, a narrow one. Scheduled and commercial banks and some urban cooperative banks can give working capital against primary gold or silver, but only if it's being used as a raw material for manufacturing. The lender has to verify it's not for investment.
Now, here's where it gets interesting, especially with silver, the weight caps. The difference between gold and silver here is just immense.
This is maybe the clearest signal that the RBI is serious about silver as a mass market asset. For gold, the limits are 1 kilogram for ornaments and 50 grams for coins. Pretty standard.
And for silver?
For silver, ornaments are capped at 10 kilograms per borrower and coins at 500 grams.
10 kilograms. That is 10 times the limit for gold. What's the logic behind that huge gap?
It's purely practical. Silver is cheaper per gram, right? So a 1 kilo limit on silver just wouldn't provide enough loan value for most families' needs.
Oh, of course.
If they'd capped at 1 kilogram, it would have been useless for monetizing most household assets. The 10-kilogram cap is a deliberate choice to make sure silver can actually compete with gold in terms of the accessible loan value.
So if you're a rural family with, say, 7 kilos of ancestral jewelry, you now have a real regulated path to get substantial credit. This leads us right into the loan-to-value ratio, the LTV. The new framework uses a tiered system, which is a big change. How does that work?
This tiered structure is a critical reform. It's designed to really help the small borrower. The maximum LTV is based on the loan size. So for loans up to 2.5 lakh, the max LTV is 85%.
85%, that's high.
It's the highest tier. Then for loans between 2.5 lakh and 5 lakh, it's 80%. And for anything above Euro lakh, the LTV cap is 75%.
So the RBI is actively favoring the smallest loans, giving them the most liquidity. But here's the tricky part, right? The rule that this LTV has to be maintained on an ongoing basis.
Yes, throughout the entire loan tenor. That is the single most important rule for risk management here.
So why is that so critical? How does that actually complicate the lender's decision?
It forces them to build in a safety buffer. The total amount owed principal plus interest can never exceed that LTV cap, even if metal prices drop.
Okay, help me visualize that. If a lender is giving a 12-month bullet repayment loan over 5 lakh, the cap is 75%, why can't they just sanction the loan at 75%?
Because of the interest. If they sanction at the max of 75% on day one, as soon as interest starts to accrue, the total debt will breach that 75% value limit, even if the silver price stays flat.
So to stay under the cap.
They have to sanction the loan at a much lower initial LTV. For a typical 12-month loan, that might be around, say, 63% to 64%. That buffer is there to absorb the interest and any minor price volatility. It's a powerful discipline mechanism.
A subtle but really powerful piece of risk management. It means more security for the lender, but it also means borrowers won't actually get 75% of the value unless the loan term is super short.
Exactly. It's a trade-off for market stability. And to make this all work, the valuation process has to be totally standardized and transparent.
No more cherry-picking prices.
None. The valuation reference must be the lower of the 30-day average price or the previous day's closing price from a regulated exchange. And it's only based on the intrinsic metal value. No gems, no stones. The borrower also has to be present during the assaying.
Which builds trust.
A huge amount of trust.
Let's shift to borrower protection, because that seems to be a major theme here. The RBI is clearly trying to fix some of the problems seen in the gold loan market and make this new silver ecosystem much more friendly from the get-go.
Yes, the focus on discipline and transparency is really exceptional. The first big safeguard is on collateral release. Lenders have to release the pledged items within 7 working days of full repayment.
And if they don't, what happens if they miss that deadline?
That's where the new compensation framework kicks in. If the delay is the lender's fault, they have to pay a penalty of 5,000 euro per day directly to the borrower.
5,000 rupees a day. That sounds like it could really hurt smaller MBFCs, especially if they have logistical issues in remote areas. Couldn't that push them out of the market?
It's a fair point, and it does impose a higher operational cost. But the regulatory view here is that this is a necessary incentive to force system upgrades. The RBI is saying the prompt return of an asset is non-negotiable.
So it's a cost of doing business in a trusted market.
Exactly. It might cause some initial friction, but the long-term benefit is market credibility, which is what you need to pull people away from the informal sector.
Makes sense. And what about the auction process if someone defaults?
That's now strictly codified. Lenders must give clear notice, wait at least a month, and set a minimum reserve price of 90% of the current market value.
To prevent fire sales.
Yes. And the lender, or anyone related to them, is strictly prohibited from participating in the auction. It has to be fair and transparent.
The communication requirements also seem very borrower-focused.
Absolutely. The loan agreement has to detail everything, the auction process, the valuation, everything. And it must be in the borrower's regional language. For illiterate borrowers, the terms have to be explained in front of a non-employee witness. It's about preventing predatory practices.
This is a comprehensive overhaul. It's not just adding silver to a list.
Not at all.
So wrapping this up, what does this all mean for the lending ecosystem? The 2025 directions feel like a move toward a unified, principle-based, and very consumer-centric environment for all secured lending.
That is the essential takeaway. It's one unified system for every regulated entity. Now, yes, it imposes higher compliance costs on lenders, especially smaller ones who need to invest in storage and IT. But the trade-off is higher asset quality, lower default risk, and ultimately stronger market credibility. Silver is finally transitioning from an idle asset into a dynamic financial tool.
A powerful transition. Let me leave you with a final thought on the competitive landscape. The new tiered LTV gives the most leverage, that 85% to the smallest loans, up 2.5 lakh. Now, gold loans have always dominated in terms of value, but silver loans have the potential to lead in reach. So how will this regulatory preference for small-ticket loans reshape the competition between big banks and those nimble NBFCs in the hyperlocal rural credit market come April 2026?